Having covered off central banks, let's go back to economic indicators. As mentioned earlier, economic indicators tend to be more objective and numbers-based. They're generally cold, hard facts compiled by official agencies or reputable third parties. Hence, market watchers, traders, and investors all pay careful attention to them. In this next section, I will go over some of the more important economic indicators that you should be familiar with. First, let's look at the labor market. Labor market figures are usually both leading and coincident indicators. Whilst job reports are very much real-time, job growth or decline impact individual household directly through consumption and saving changes, which may take a little bit more time to get into the system. An example of an important labor market indicator would be employment and the corollary of that, which is unemployment. If we assume that total employment measures the current output potential, then unemployment measures the spare labor capacity, or effectively the wasted resources within the system. You may also hear a lot of noise about unemployment rates, which is simply the number of unemployed as a percentage of the labor force. It also indicates the strength of the economy if companies are actively hiring or firing staff. Many economists also closely follow labor productivity, and that is the output per unit of labor, as this measures the overall productivity of a workforce. However, the big daddy of labor market economic indicators is the change in U.S. non-farm payrolls figure, or simply the payrolls. This figure is released on the first Friday of every month at 8:30 a.m. New York time and measures the economic growth via new job creation in the U.S. in all sectors other than farming, and it's a proxy for U.S. economic growth. All market participants across the world watch this release closely, working late into the night in Asia. Note that central banks watch labor market indicators very closely as well, as full employment is one of their mandates, generally, and each central bank has their preferred measure of labor market indicator. The next category of economic indicators that we're going to look at are broadly defined as output related. These figures track economic activity of a region or a nation as a yardstick for economic achievement. Examples of these types of indicators would be GDP, which adds up all spending in an economy, meaning consumption, investment, government expenditure, and net exports. This sum is the gross domestic product of GDP of a country or area. The gross national product, which is gross domestic product, GDP, plus property income, net property income from abroad, and rent, interest, profits, and dividends, and also the balance of payments, which is the net amount of transactions between one nation and the rest of the world over a given time frame. This net amount of transactions includes both the country's capital account, which measures capital flows like investments and dividends, and the country's current account, which tracks imports and exports of goods and services. And they're very important, especially for large export-driven economies. You may sometimes hear about GDP per capita in the news, which is simply the GDP of a nation divided by the population. This figure is important as it's an indicator of overall economic welfare and used as a threshold between developing and developed nations. Generally, countries with GDP per capita of over 15 to 25,000 US dollars is considered a developed nation. As output measures take a fair amount of time to calculate and can be seen as the effect of other economic policy decisions, output is generally viewed as a lagging indicator and at very best a coincident indicator. Following output, I would like to touch next upon prices and wages, which directly measures inflation. Central bankers very much focus on these sorts of indicators as many of them are tasked with maintaining price stability and use inflation to determine when to loosen or tighten monetary policy. There can be a slight timing issue, as most inflation figures are lagging indicators, and they tend to reflect the effects of some other economic policy. Broadly speaking, we can look at inflation and the impact on the consumer, which is generally measured by using a basket of goods and services purchased by an average household every month. They may also take out other expenditures like housing or energy to make apples-to-apples comparisons. Central banks tend to have the measure they favor individually, such as the ECB focusing on HICP, which stands for Harmonized Index of Consumer Prices, and the US Fed focusing on PCE Core Deflator. Inflation can also take effect on producers and output prices of goods at the factory door that are a useful indicator of cost pressures on domestic manufacturing. Lastly, we can also see the impact of inflation on wage costs. Labor costs and the impact on consumer income result from wage cost changes, and unit labor costs track productivity. In most developed economies, the largest contributor towards economic activity is consumption. Economic indicators such as retail and wholesale sales, as well as consumer spending, indicate both the real-time health and future direction of the economy, which is why consumption can be both leading and coincident indicators. Some examples of consumption figures may include personal expenditure, which is a key component of GDP and the basis for consumptions and savings. Maybe vehicle sales would be another good example. As the second largest single purchase a household makes after the home, consumer demand and the manufacturing of motor vehicles can be a trend to pay attention to. One other example would be retail sales, especially during peak shopping seasons like Lunar New Year, Christmas, Black Friday. They provide excellent leading indicators for corporate earnings as well as real-time consumer demand. Next, let's look at the industrial sector and some of the primary economic factors or indicators for that sector. Firstly, industrial production is a strong coincident indicator of industrial activity. Capacity utilization, meaning how much existing plants and machinery in an economy are being used to indicate output as well as inflationary pressures. Manufacturing orders are also an important indicator as they measure new orders received by manufacturing companies. So why are these important? It's because the category of indicators within the industrial sector are generally a strong leading indicator, as industrial orders have a longer lead time, so therefore it takes longer for the output to hit the system. Additionally, industrial orders tend to be larger ticket items, so the impact to an economy can be quite significant. If you think of, say, Boeing jets that are produced in the US and sent overseas, that contract value can actually be very significant. As mentioned earlier, Purchasing Managers' Indices, or indexes, called PMIs, are a hybrid economic release that captures anecdotal subjective factors, in this case, business conditions, and trying to put it into a number. Many of the well-known organizations that provide PMIs, like the U.S. Institute of Supply Management, ISM, Britain's Chartered Institute of Purchasing and Supply, CIPS, and the IFO Institute in Germany, are private sector bodies. Nonetheless, they are very reliable as they give early signals of changes in economic trends and are considered reliable as a leading and coincident indicator. PMIs are extracted from surveys that they take from purchasing managers in service and manufacturing companies about their views on prevailing economic conditions. Generally, a figure greater than 50 indicates expansion, whilst a figure that's less than 50 indicates contraction. Much like PMIs, surveys about consumer and business confidence, as well as sentiment, are also a hybrid type of economic indicator. These use anecdotal results from surveys to form a numeric index figure. Also, like PMIs, these surveys tend to be forward-looking, so they're really good leading indicators. For consumer confidence, survey takers track consumers' perceptions of their economic well-being, which determines short-term spending, borrowing, and savings plans. For business conditions, again, surveyors get anecdotal measures of business sentiment as early warning of changes in the economic cycle. Overall, consumer and company attitude surveys about the degree of optimism or pessimism reflect into factors such as individual savings or company expenditures. The last group of economic indicators that I will talk about is broadly defined as housing-related or housing sector figures. As housing forms one of the largest portions of an individual's assets, the outlook for this sector is important as both a leading and coincident indicator. Examples of these sorts of figures start from when construction permits are issued, called building permits, to construction orders and housing starts, through to sales figures and leftover inventory. There are numerous house price indexes as well, the best known in the U.S. being what used to be called the Case-Shiller House Price Index, but is now known as the S&P CoreLogic CS House Price Index.